Derivative instruments are fundamental tools in modern financial risk management, (FRM), enabling organizations to manage exposures arising from fluctuations in foreign exchange rates, interest rates, commodity prices, and other financial variables. Rather than eliminating risk entirely, derivatives allow firms to transfer unwanted financial risks to counterparties better positioned or more willing to bear them. Within the CPA Australia Financial Risk Management Framework, derivatives are viewed primarily as hedging instruments that enhance earning stability, protect cash flows, and support strategic decision-making. Successful application of derivatives requires an understanding of contract structures, pricing mechanisms, trading processes, and their economic implications, together with appropriate governance and risk management controls. Forwards. A forward contract is a customized agreement between two parties to buy or sell an underlying asset at a predetermined price on a specified future date. Unlike exchange-traded derivatives, forward contracts are negotiated privately in over-the-counter (OTC) markets, allowing contract terms to be tailored to the needs of the contracting parties. Forwards are widely used by corporations to hedge exposures arising from international trade, commodity purchases, or future financing requirements. By fixing future transaction prices, organizations reduce uncertainty surrounding future cash flows and improve budgeting accuracy. However, because forwards are privately negotiated, they expose participants to counterparty credit risk, as contractual obligations depend on the financial capacity of each counterparty. Foreign exchange forward contracts. Foreign exchange forward contracts are among the most common corporate hedging instruments. They enable organizations to lock in an exchange rate today for the purchase or sale of foreign currency at a future date, thereby eliminating uncertainty associated with currency fluctuations. Importers may use forward contracts to fix future foreign currency payments, while exporters may secure future receipts by selling foreign currency forward. These contracts stabilize future cash flows and reduce the impact of exchange rate volatility on profitability and financial planning. Trading process. The forward trading process begins with negotiation between counterparties or through financial intermediaries. Contract terms specify the underlying asset, quantity, settlement date, and forward price. Unlike exchange-traded derivatives, forwards generally remain outstanding until maturity, when physical delivery or cash settlement occurs according to the agreed contractual terms. Because contracts are customized and privately negotiated, secondary market liquidity is generally limited compared with exchange-traded instruments. Interest rate forwards. Interest rate forward contracts enable organizations to fix future borrowing or lending rates, thereby reducing exposure to fluctuations in market interest rates. Treasury departments frequently use these instruments to protect future financing costs or investment returns, particularly when significant borrowing or refinancing activities are anticipated. Interest rate forwards contribute to earning stability by reducing uncertainty surrounding future financing expenses and supporting long-term capital management strategies. Forward price of commodities. Commodity forward prices reflect current spot prices adjusted for financing costs, storage expenses, insurance costs, and convenience yields associated with holding physical inventory until future delivery. Forward pricing therefore incorporates both market expectations and carrying costs, enabling commodity producers and consumers to establish future transaction prices that reduce exposure to volatile commodity markets. Contango and backwardation. Commodity forward markets may exhibit either contango or backwardation. Contango occurs when forward prices exceed current spot prices, typically reflecting positive storage costs and financing expenses associated with holding inventory over time. Conversely, backwardation occurs when forward prices fall below spot prices, often indicating strong immediate demand, limited supply, or a convenience yield associated with current physical ownership. Understanding these market structures assists treasury managers in designing effective commodity hedging strategies. Futures. Futures contracts perform functions similar to forwards but differ significantly in their trading structure. Futures are standardized contracts traded on organized exchanges, with contract specifications regarding quantity, quality, maturity dates, and settlement procedures predetermined by the exchange. Exchange trading provides greater liquidity, price transparency, and reduced counterparty risk because central clearinghouses guarantee contractual performance. Participants maintain margin accounts and positions are marked to market daily, requiring gains and losses to be settled continuously throughout the contract life. The futures trading process involves entering positions through licensed brokers, maintaining margin requirements, and closing positions through offsetting transactions or settlement at maturity. Standardization and active secondary markets make futures highly efficient instruments for managing financial risk. Swaps. A swap is a contractual agreement between two parties to exchange future cash flows according to predetermined terms. Swaps allow organizations to alter the characteristics of existing financial obligations without refinancing underlying debt. Economic equivalence. The concept of economic equivalence recognizes that different financial structures may produce identical economic outcomes. Through derivative contracts such as swaps, organizations can synthetically transform financial exposures while leaving underlying assets or liabilities unchanged. For example, fixed-rate borrowing combined with an interest rate swap may create an effective floating-rate obligation, demonstrating that derivatives can replicate alternative financing structures economically. Relevance of economic equivalence. Understanding economic equivalence enables treasury managers to compare financing alternatives, optimize capital structures, and exploit market opportunities without physically restructuring debt portfolios. This flexibility enhances financial efficiency while reducing transaction costs associated with refinancing activities. Interest rate swaps. The most common swap arrangement is the interest rate swap, where counterparties exchange fixed and floating interest payment obligations based on a notional principal amount. Interest rate swaps enable organizations to modify interest rate exposure according to market expectations and financing objectives. For example, a borrower with floating rate debt may swap variable interest obligations for fixed payments to achieve greater earning certainty, while another organization may prefer floating exposure if interest rates are expected to decline. Options. An option provides the purchaser with the right, but not the obligation, to buy or sell an underlying asset at a predetermined exercise price before or at a specified expiration date. The seller, or writer, receives a premium in exchange for assuming contractual obligations should the option be exercised. Unlike forwards and futures, options provide asymmetric risk protection, allowing downside risk to be limited while preserving favorable upside market movements. Option pricing. Option pricing reflects the probability that exercising the option will generate economic value before expiration. Sophisticated pricing models incorporate expected volatility, time remaining until expiry, interest rates, exercise price, and underlying asset price movements to estimate fair option values. Other option terminology. Important option concepts include the exercise, strike, price, expiration date, call option, right to buy, put option, right to sell, intrinsic value, time value, and moneyness, which describes whether exercising the option would currently be profitable. Understanding these concepts enables treasury professionals to evaluate option strategies and associated financial exposures accurately. Hedging using options. Options provide highly flexible hedging solutions because they establish maximum downside exposure while preserving opportunities to benefit from favorable market movements. Importers may purchase currency call options to protect against exchange rate increases while benefiting if currencies weaken. Similarly, commodity producers may purchase put options to establish minimum selling prices while retaining upside potential if market prices increase. Determinants of option premium. The option premium depends upon several factors, including the current price of the underlying asset, exercise price, expected market volatility, time remaining until expiration, prevailing interest rates, and expected dividends or cash flows associated with the underlying asset. Higher uncertainty and longer maturities generally increase option premiums because they increase the probability of favorable exercise opportunities. Uses in hedging. Options are widely used to hedge foreign exchange exposures, interest rate movements, commodity price fluctuations, equity investments, and portfolio risk. Their flexibility makes them particularly valuable when organizations seek protection against adverse market movements while preserving participation in favorable outcomes. Overall, forwards, futures, swaps, and options represent essential derivative instruments that support comprehensive financial risk management. When implemented within appropriate governance frameworks and aligned with organizational risk appetite, these instruments enable treasury managers to manage financial uncertainty effectively, stabilize cash flows, optimize financing strategies, and enhance long-term organizational value.